And now for something completely different.
It's a fast world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to, well, you know what it is today? Second best day of the week.
Yeah,
that's
baby.
what it is. That's right. It's Thursday. Getting ready to head into the weekend, of course, as we get ready to wrap this week up. So interesting news out this morning. Dr. Michael Osterholm, who is the coronavirus advisor to President Biden, has recommended that we shut down the economy for 4 to 6 weeks, and that will basically get us past the virus, right? This will get us past it. So is that a good idea, right? This is the idea. Now, he says a couple of things here that are very important to consider, right? So I'm not arguing with the man. He is the head of the Center for Infectious Disease Control. So, it's when it comes to epidemiology, he's the guy. And this is one thing that's been very fascinating about this whole event of the pandemic. I've never seen so many economists and financial people become epidemiologists in my entire life, right?
It's a Christmas miracle.
I know, right? All the financial media, they know it all about epidemiology, right? So don't argue with the man that has multiple degrees and is the head of the Center for Infectious Disease Control about epidemiology. He is right about that, right? He understands the virus part. What he doesn't understand is the economics of it. And this is the important thing. And this has been the same problem that we have. Everybody becomes an expert in stuff they have no idea what they're doing. But, it sounds great, right? So what he says is, and this is important, he says, the government can borrow enough money to pay for a package that would cover lost income for individuals and governments during a shutdown. Great. We can go further into debt. We're already running a $3.1 trillion deficit now. That'll be closer to $4 trillion by the end of the year. And of course, we now borrow $5 of debt for every $1 worth of economic growth. We've gone through this before through the show. The problem is borrowing more money and giving people money today to spend, and that's even assuming they can spend it. What that does is that brings forward consumption that you might not have used otherwise. So it just creates another void in the future. So I give people money today, they spend it, it's over, then what? Right? That's the other question. The other problem is that yes, we can certainly borrow more money. And by the way, there's a very long historical track record of higher debts leading to weaker economic growth. But yes, we can certainly borrow enough money now to give people money. That's great. But if the economy shut down for 4 to 6 weeks, where are they going to spend it? Yes, they'll buy groceries, right? They'll pay their rent, they'll pay their water bills, do those things. But what about the other businesses that are also shut down, right? Bars, restaurants, hair salons, dry cleaners, you name it, right? If people can't go out because they're locked down, what happens to those businesses? Well, a majority of those businesses are still struggling. We lost a tremendous amount of small businesses during the first lockdown when we did this. The experience of that was not good economically. And that if we do this again, a lot of these ailing businesses that have managed to hang on up to this point will be lost. Small businesses make up roughly about 50% of the employment in this country. They make up about 50% of GDP in total. Small businesses are incredibly important. If you take a look at corporate formations, right? You hear a lot of this, and whenever time the Bureau of Labor Statistics announces the employment report, they say, and, part of this was small business creation. We had a record number of small businesses that were created in the last quarter, in the midst of the pandemic. People were just going out and starting their own business. That's not true. What they were doing is going out and forming corporations, LLCs, limited liability corporations, et cetera, for trust, estate planning, these type of things. In fact, if you look at the 32 million some odd businesses in the country, only about 6 million of them actually have an employee. Right? So only about 1/5 of all the small businesses actually have employees, and about 80% of those have less than 5, right? So a majority of the businesses in this country are smaller businesses, 5 or fewer employees. They're your local dry cleaner, your retail store on the corner, your little, your hair salons, your massage parlors, all those things, right? All those things that we use, those little service businesses that are all around us, and every little strip center Incredibly important to the economy. And if I can't get out and spend that money that you sent me, great, I've got this money, you sent me money, can't spend it. Nowhere to spend it. Those businesses go out. We lose a very important factor to our overall economy and our longer-term recovery. So shutting down the economy certainly does not lead to his final conclusion, which is we could really watch ourselves cruising into the vaccine availability in the first and second quarter of next year while bringing back the economy long before that. No. No, sir. No, Dr. Michael Ostrom. No. You shut down the economy, you don't build a stronger economy by shutting it down, you make it weaker. And more importantly, the Pfizer drug is not going to be available for distribution anytime soon. I'm actually writing a report on this for Monday. The Pfizer drug requires it to be stored at negative 94 degrees. It requires special freezers to house the drug. So all these hospitals out in major cities, yes, they have these freezing facilities. They can get access to this. But a lot of these smaller rural towns do not have the availability for it. It'll have to be shipped in dry ice. When it gets there, it's got to be frozen. If it doesn't get frozen, then it's got to be reshipped, right? So this is a bigger problem. First of all, but that's just the storage problem. The other problem is that the Pfizer drug's only in phase 3. It's still got to go through phase 4. It's still got to get FDA approval. It's got to go through phase 4 trials. That's got to make sure that we don't have any adverse effects. About 90% of drugs fail between phase 3 and phase 4. So there's still a very high probability that this drug will deliver some type of adverse side effect that will keep this drug from being a viable vaccine. And then the other parts of the administration for working for Biden are recommending that we send this drug worldwide before we even give it to all of the U.S. residents, right? Because we need equal distribution around the world. Everybody needs fair and equal distribution and access to the drug. The problem is countries like Africa do not have the medical facilities or capabilities to store and deliver the drug. Right? So this is just fraught with problems. So the reality is that no, we're not going to have a vaccine in the first and second quarter of next year. It may be towards the end of next year. But more importantly than that, if you shut down the economy again, you will not have a stronger economy to be working with when you get to the vaccine, and will be that much further into debt. So, again, you have to really kind of pay attention to what's going on behind the scenes. You get the government that you vote for. And this is going to be one of the problems that will potentially plague the markets as we go into next year. Markets are already exceedingly overvalued and extended from long-term means. The economy is getting weaker, not stronger. And the more debt and deficits that we continue to accrue as we move into next year will begin to further impale on economic growth. And remember that while the stock market is not technically the economy, the economy is where stocks derive all their revenue and earnings from. So weaker economic growth, shut down the economy. That's going to be weaker for the stock market as well, reducing corporate profitability. But pay attention here. We're back up testing a previous top here at all-time highs today. Market is going to be lower at the open, at least on the S&P 500 and the Dow, down a couple hundred points. Again, we're still struggling within this consolidation range we've really been in going all the way back to September of this year, have not really resolved that. And as we have now burned up a big chunk of that money flow buy signal, we're starting to get back into the point here where we're likely to see some market weakness here over the next couple of weeks. We're going to talk more about this in just a moment with Mr. Michael Lebowitz, CFA. He's going to join me right after the break. We're going to talk a little bit about the Fed coming up this week and more. Don't go away. I'm your host, Lance Roberts, right here on The Real Investment Show.
Little sister shotgun with a nice thing to start again. It's a nice day for a white wedding. It's a nice day to
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
show this morning at 6:18. Welcome to the Real Investment Show. I'm your host, Lance Roberts. For our new audience in Austin, joining us on Talk 1370 this morning. Every week we have Mr. Michael Lebowitz, CFA. He used to work for the government. He was on the inside guy, right, with Fannie Mae, Freddie Mac. So we like to have him here every week and talk a little bit about what's going on with the Fed, what is happening from the Federal Reserve, what it means for the economy. Just a second ago, as I was talking about Dr. Olshram, who is the head of the Center for Infectious Disease Control, is now an advisor to Biden's COVID task force, is saying we should just shut down the economy for another 4 to 6 weeks. That'll get us past the virus. And by the time we get past the virus, the economy will be super strong because we'll send more money to people. Problem is that sending money to people, as I was saying, if the economy shut down, they can't spend it, so it doesn't make the economy stronger. There's the other half of the equation. I can send people money, but they have to be able to spend it. And yeah, of course, yes, there are certain companies that will absolutely benefit from checks. Right. So grocery stores, Costco, people, buying groceries, these type of things during a shutdown, those things will certainly benefit and participate during a shutdown. The problem is that we'll lose a large chunk of our economy as small businesses, which have managed to hang on this long. Right. We've already lost a tremendous chunk of our small businesses in the country from the first shutdown. Bankruptcies are well on the rise. We shut down for another 4 to 6 weeks. We're going to just send that spiraling even higher and lose a very important dynamic of economic growth going forward, which is small businesses. So anyway, having said that, I wanted to bring Mike in a little bit to talk about a little bit about this. Right. The Federal Reserve has been pretty quiet lately, right? Ever since the election's been gone, they haven't been saying a whole lot. And kind of one of the interesting questions coming out of all this is, coming out of, where we were, the Federal Reserve has been quiet. There has not been any more stimulus. There is a relationship between the amount of stimulus issued by the government and what the Fed can do in terms of QE and a lot of these programs. And, a lot of these programs that we saw the Fed do to help support the economy, like PPP, the payroll protection program, which was rife with fraud. We had a lot of companies going to get the PPP program just to get people were forming companies and applying for loans to get loans. So just billions of dollars worth of fraud there. But we never even actually used all of that program. And a lot of the other programs were barely tapped at all.
Right. And you know what? I think you forgot a very vital part of that whole story, Lance. Let's just pretend in this make-believe world that these politicians live in, that they give out a whole lot of money and everyone spends it and the economy is just the way it was in 2019, right? Right. That's their dream and that's what they think is happening. And it's not going to happen. Some people get a lot of it. Most people get not enough of it, right?
Right.
That's what happens. But in the long run, what's going to happen? Well, there's more debt on our books. We've bought stuff today that we would have waited till March or June to buy, and we don't have the desire to buy a car. We don't need to buy a car. We don't need to buy this or that. So they've pulled forward the consumption, and they've replaced it with debt that has to be paid back in the future. So by necessity, your economic activity will be less in the future than it would have been if they had done nothing. Now, that's a trade-off. And some politicians are more than willing to accept it because they're not going to be politicians in the future. But all of us are going to be citizens in the future of this country that have to deal with a slower economic growth rate. And it's not just about will their actions work today. Some will, some won't. They will certainly help economic activity and help people. And we can debate that all day. But the thing that's not debatable is that the future economy. And I'm not talking about 20 years and our children. Our future economy, 3-4 years from now, is going to suffer necessarily as a result of what they have already done and what they will do. And not even COVID, just running massive deficits in, through the last decade is doing the same thing, just on a not as visible scale.
Right. Well, it's interesting. We keep trying the same thing over and over again, hoping to get different results. Is okay. Well, maybe if we do some more spending and we go further into debt, next time it'll be enough, right? And this has even been one of Paul Krugman's favorite points is that we just the only reason that debts and deficits didn't create economic growth is because we just didn't do enough of it. But the reality is that debts and deficits don't create growth. They actually deter from growth when those debts are not used for productive investments. And that's the problem, is that if I give you money today to go buy groceries with, yeah, there's a very short-term impact to the economy because you went and bought groceries with that money. But then what about next time? Then what about next week when those groceries are used up and there's no more money to buy with?
That's an incredibly important point you just said there, right? It creates activity. It doesn't create growth. It actually detracts from growth. And they sell you on growth, but really what they're creating is activity today at the expense of growth tomorrow. And that's fine if there's going to be one recession, one depression, and you do it once, and then you reverse it out over the course of the next 10 years. But as we've seen, it's just more activity, less growth.
Well, and again, this has consequences, well outside of that. We've looked at the reasoning why, the economy is where it is, and it's amazing, right? We talk about 2% economic growth, and we're like, man, if we can just get to 2% economic growth, we'll be back to pre-pandemic levels, and that'll be awesome. We used to talk about 2% growth being pre-recessionary back in the 90s. That's when we were growing at 4 and 5% economic growth. 2% economic growth is not really good. 2% economic growth, you're barely keeping up with the rate of population growth coming into the economy. You're not creating economic prosperity through higher rates of growth. And we've seen this, right? We've seen a widening of the wealth gap. We've seen more dissension within the economy between the haves and the have-nots. But we've come to accept this idea that 2% growth is okay. But it's not. This is basically a patient on life support. It's like, okay, well, he's on life support and he's still alive. Well, he's good, right? No, he's not walking out of the hospital anytime soon. He's on life support, and you pull the life support off, we have other problems.
Right. It's per capita GDP. How much GDP is there for each of us? Forgetting even how evenly it's distributed, right? That's a huge thing. And everyone seems to forget that basically our GDP per capita is close to zero, right? We're not growing. And yeah, our GDP may be growing, but the number of people that are feeding off that GDP are growing just as quickly. And, we can debate all day about the quality of GDP as well, but we see it in our incomes. We see it in corporate profits, not just Apple and Amazon's profits, but when you look at corporate profits, they haven't been growing. Our incomes haven't been keeping up, right? It's the signs are everywhere. Whether you want to use GDP or anything else economic, the growth in this country has come to a standstill almost, and it probably will be after this COVID recession or whatever is going to come of this is over.
Yeah, no, and it's interesting that you brought up corporate profits because, that's something I don't think people really, kind of gravitate on very much because we don't pay much attention to it. We pay a lot of attention to earnings per share, which, we no longer really report earnings per share on a GAAP adjusted basis. We report these operating pro forma earnings that are, how I would like earnings to be before all the bad stuff happens, like I have to pay bills, But if you take a look at corporate profits, which is what is actually reported to the IRS for tax purposes, those haven't grown at all. Period zero, have not grown since 2014, and actually are now, very close to where they were back when we just came out of the financial crisis in 2010, 2011. So, corporate profitability has not improved over the last decade. But, when we're talking about the stock market, hey, that looks great, right? We've got stock markets at record highs. What could be possibly wrong? And obviously, the stock market is telling us the economy is doing just fine.
Right, and let's remember the S&P 500 is an elite class of companies. There's many other companies that constitute corporate profits, and even within the S&P 500 and the Dow and the Nasdaq, they report earnings, like you said, in squirrely ways. First and foremost is earnings per share. So if you reduce the number of shares, their earnings go up, but their profits aren't going up. Their dollar earnings aren't going up. It's their earnings per share are going up, right? And, like you said, the bookkeeping is questionable. Things like J.P. Morgan, who is paying fines, seems daily, right, to the SEC, to the DOJ, to all kinds of entities.
Yeah.
Those never get reported. Those are one-time events. They're not recurring. Why should they matter?
Yeah, and they're tax write-offs on top of that.
and their tax write-offs.
Yeah.
So they don't show up in the bottom line. And this is true for many companies, not just the big banks. And it's, when we tell people corporate profits haven't moved, they say, well, look at Amazon, look at Microsoft. I'm like, yes, they've done well. But there's thousands and thousands and thousands of other companies that have gotten their business stolen from Amazon, for example.
Right. Well, no, and it's very true. When you take a look at, for instance, when you take a look at corporate profits, what a lot of people don't understand is that buried in corporate profits, which are reported, is the Federal Reserve's balance sheet. So all the income that comes off the Federal Reserve's balance sheet that they're getting from government, converting government debt into their balance sheet is actually making corporate profits look higher than they actually are. So actually, once you strip out the Fed's balance sheet, now it's not negligible. I mean, these are billions upon billions of dollars in interest income that they're receiving off this, $7 trillion balance sheet now.
Right.
So, it's not
and growing
and growing. This is not negligible income coming in that's affecting the profits of what we see reported on a corporate profit basis. But look, these are what we deal with. But I do want to come back and talk a little bit about the markets here, because markets are, honestly, if you step back and don't look at anything else and only look at the stock market, if you've been asleep for 20 years and woke up, you say, man, U.S. economy's rocking. Come back and talk about that with Michael Lebowitz, CFA. Don't go away.
Girls hit you hallelujah, girls hit you hallelujah, girls hit you hallelujah. Get up that back up, give it to ya. Get up that back up, give it to ya. Get up that back up, give it to ya. Saturday night we hit the spot. Don't believe me, just watch.
Listen anyplace, anytime at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back to the show this morning. I'm your host, Lance Roberts. 6:33 as we get into the second best day of the week, Thursday. The one thing here is, by the way, get by our website, realinvestmentadvice.com. Michael Lebowitz has a new article out on our website right now called Cobra Windows and Executive Compensation as part 2 of a 2-part series on, kind of what the side effects of, doing all these kind of crazy things that we do economically in terms of providing incentives. And not necessarily did we ever provide these incentives intentionally, but through legislative action, through other actions that we've taken, it creates other incentives that have not worked out well in a lot of cases. And executive compensation being one of those. We were just talking a moment ago about corporate profits, and when you take a look at corporate profitability, there was a recent survey out of CEOs around the country, and CEOs and CFOs admitted that as much as 10% of the profitability they report on their books is fudged, basically just through accounting gimmicks, etc., because they have a need to make sure they report good earnings so that the price of the stock goes up, so that their executive compensation rises because they're compensated in stock. And so whenever you provide an incentive to be compensated for something, then you're by very nature going to incent people to cut corners and to do things otherwise. There's a really good example of this, and if you ever read the book, The Smartest Guys in the Room, it was a book about Enron. And a lot of people in the markets today really don't know much about what happened with Enron. I was right in the middle of it. It was here in Houston. I was doing a lot of reporting on local news stations at that time about what was going on with Enron. But the main reason why Enron failed was, well, besides the lying and the cheating,
but the lying and the cheating came from the fact that they were incenting their energy traders, that the more they sold on energy trading, then the higher compensation they get paid. And these guys were making millions of dollars every year being compensated for their energy trading. Well, of course, when you're being incented that way, we also saw this with Wells Fargo just a couple of years ago. Whenever you incent people with money, ironically, to do something, they're going to find a way to cheat. And that's what ultimately brought Enron down, and that's what ultimately brought Wells Fargo's down as well, when they got caught on their account scandal. But this is what the article talks about. It's a really, really good read, and you'll learn a lot from it. But it's on our website now, and again, both parts are there as well. And there's a link internal so you can get the first part right there on the website, realinvestmentadvice.com. That's realinvestmentadvice.com. It's the article up on the page right now. So. Go ahead.
But let me add a few points to that.
Sure.
It's the article is not necessarily about executive compensation, how they're getting paid too much, because at the end of the day, that's not. I mean, people may perceive it as a problem. It may be. It may not be. I think the bigger problem is that their executive compensation is so out of hand because they're paying themselves in stock.
Right.
So where are their incentives to get this share price higher today? Right? That's their incentive. So what do? They don't invest in a company because they don't care where the stock is 10 years from now. They care about where it is today. They don't care about their employees. They want to make sure they're getting the maximum out of their employee today. They're buying back shares of the stock. Why invest? Just buy back shares of stock.
Right.
So all this has a negative effect on the company in the future, but even worse, we all pay the price because it negatively affects the economy and all the citizens of the country. And I would, even say the world, because we're not investing in productivity. We are investing in some executive's wallet, essentially.
Well, that's true.
And when it's done over and over and over again with many of the largest corporations, that bad incentive, right? Share price versus, a simple way to fix this is say, okay, corporate executives, you can make whatever you want, but that's going to be based off what the company's, these financial metrics or other metrics are 5, 10, 20 years from now, not what the share price is. I mean, we've seen share prices are disconnected from reality at both the market level and an individual stock level. So why are you compensating based on what appears to be a random number?
Well, again, this, and there's multiple examples of this, and I want to get back to the market here in particular, but for instance, when companies announce earnings, they have their conference call. Well, CEOs have now figured out that all these artificial intelligent algorithms are listening to their conference calls, and then those are triggering stock buy or sell programs in the markets. And so when they make their announcement, CEOs and CFOs have figured out they need to put keywords that these algorithms are listening for within their announcement. So that triggers a positive side effect of the algorithms going, oh, I heard the keyword, go buy this stock, and the stock price goes up. And that's why we're seeing these abnormal jumps in stock prices. Just recently we saw, companies announce earnings and they're up like 30% the next day. Salesforce, they announced their earnings, stock was up 27%. Their earnings did not justify a 27% jump in the stock, but it was because all these algorithms, which also triggered passive investing, ETFs, et cetera, all ran and one problem. So we've got a lot of, and this was the point I wanted to get to, Mike, is that if you had gone to sleep in 1999 and just woke up today, you would look at the stock market and go, stock market's at all-time high. The economy must be cooking, right? I mean, we've had this tremendous increase in stock prices over the last decade. The economy must be fantastic, but yet we have this huge disparity in the economy in terms of wealth. Top 10% owns basically about 90% of the stock market. For most people, they don't participate in the overall wealth and prosperity of the economy. That's a problem, right?
Right. It's not the economy. The stock market is not the economy. It's a place where companies can go raise capital in theory, but that's not what it is either. It's become a betting parlor, right? I mean, and the sad part is that's fine. And the stock market serves a purpose, but it's, a lot of it, investors and this and that. But at the end of the day, that is our economic policy, fiscal and monetary, right? What is the Fed always looking at? The Fed, our monetary policy is based off the stock market. They're so scared of it falling that it's going to have such a disastrous effect. But they don't understand that what they're doing to support it is creating the wrong incentives. It's putting money in just a few people's hands. It's not leading to a better distribution of the nation's profits. And we have a lot to blame for this policy.
Now, first of all, let me be really clear here that, when the stock market goes up, that's good for me personally because I'm invested, right? I have money saved up. I've done financially right things. I've built businesses and these type of things. So, I've participated in the capitalist system. And so when stock markets rise, they certainly benefit me. And probably if you're listening to the show right now, you've got money invested because you're at least interested enough in your money to want to listen to a boring financial show, to figure out why the markets are doing what they're doing. But if you're listening to the show right now and you've got money invested, seriously, you are within the top 10% of the economy. And that's hard for a lot of people to fathom. If you've got $1 million saved up, you're in the top 5% of the economy. That just tells you how, really how wide that wealth gap is. When you're getting into the 90% or under, the majority of those people have less than $500 saved up. They have less than $1,000 saved up in retirement plans. The average retirement plan, right? And everybody says, well, everybody saves in a 401k plan. Not true. Out of the 100% of employees in the country, only 50% have even access to a 401k plan because most small businesses, again, 50% of the economy, don't have 401k plans. They're too expensive to run for companies with 4 or 5 people. Of the 50% that actually have access to plans, only 50% of those. So only 25% of people actually contribute to a 401k plan. And about 90% of those have less than 1 year's salary saved up in their plan. So, the disparity, and this is to Mike's point, the disparity between what's happening in the stock market and what happens in the economy are two vastly different things. And no, everybody's not getting rich off the stock market, particularly after 2 major bear markets. A lot of people just quit investing anyway. Right. And the problem is now we're setting up potentially for another, problematic event at some point in the future. What causes the next crisis of confidence in the markets? Who knows what that'll be? But we've certainly got all the ingredients for it. Excess valuations, extended credit, credit spreads are, extremely tight. There's a lot of risk that are built up in the markets that are all dependent upon the Fed doing something. And if they don't do something, the wheels come off the cart.
Right. And just real quick, I would add that the guy with $1 million that has $1 million in the stock market, his wealth, his well-being, financial well-being, all that is tied to his income, right? It's not that $1 million. That income is part of the economy.
Right.
Right. So even the wealthy, the large majority of that 10%, they're vested more in a stronger economy that pays them well versus their stocks going up.
Right.
Right. So it's not just the 90% that care about the economy. It's virtually, almost the whole 100%.
Right. But again, the real point here is that you've got to be careful when you look at the stock market and assume. And look, whether or not you like Trump as president, this was his big mistake. While he was president for those 4 years, he tied his entire presidency to the stock market, right? So when the stock market went up, he was doing a great job as president. When the stock market went down, he went and leaned on the Federal Reserve to do more. And it created a lot of volatility and angst in the markets over the last couple of years in particular. But the problem is that you've got to focus on creating stronger economic growth. If you do those things, the rest of it will take care of itself, and the stock market will follow. But we don't let that happen.
It's the old field of dreams. Build it, and they will come.
Exactly. All right, come back. We're going to pick up some more with Michael Lebowitz, CFA. Want to switch gears a little bit. The Federal Reserve just had their meeting recently. Didn't say a whole lot. Got some minutes coming out as well. What the Fed might do next. We'll get to our Fed expert, Michael Lebowitz, right after the break.
listening to The Real Investment Show.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. You know, we were just talking a little bit a second ago about the Federal Reserve. Federal Reserve recently had their meeting. They've got another one coming up in December, right, Mike?
Yeah, late December. 6 weeks from last week. 5 weeks.
5 weeks. There we go. So it'll be in December. At the last meeting, they really didn't say a whole lot. No real change to their policy stance in terms of keeping interest rates low. Still kind of banging on Congress for stimulus at this point, and the reason is they've got to the government's got to issue more debt in order for them to basically buy that debt from the government, what we call monetization. So they buy the debt from the government, and then they can provide excess reserves to the banks. And hopefully those banks are supposed to be lending it out. But interestingly enough, I put a chart out on Twitter this morning showing the fact that, you know, the demand for corporate loans is plunging right now. Corporations don't want to go into more debt here, not with the economy weak. And potentially now with people talking about shutting down the economy again. I mean, you certainly don't want to go further into debt at this point. And go into an even weaker environment if that would occur. So, you know, the problem is the Fed's really kind of in a bottleneck here in terms of doing anything. And they were pretty tight-lipped at their last meeting. Kind of what do you expect to be coming out here?
No, and that's, there's another tell, and it's how many Fed members are speaking every week. It's crazy how many of them are on the speaking docket, putting out comments to the news networks, speaking in front of on Zoom things or whatever they're doing. And it reminds me of my kids, especially my boys. My girl's smarter than me, so that one, she doesn't count. But my two boys, when you accuse them or something or they're trying to cover something up, they keep talking. All you got to do is sit back and listen. And they keep talking and talking and talking. They don't shut up. They keep trying to explain how it couldn't have been them and had to have been someone else. And they're giving you 10 different theories on why it's not them, right? That's how you know it's them.
Right.
My girl's a lot smarter than me, so she's figured it all out 10 years ago. Anyway,
so she just says, wasn't me, and walks off?
Right. How could it have been me, Dad? And then leaves. I'm like, you're right. How could it have been you? Sorry, Jacob and Andrew. So anyway, every week for the last, what has it been, 4 or 5 weeks now, there's 10, 20 speakers, some men and women speaking 4 or 5 times a week. They're saying the same thing. They're not saying anything new, but they just keep going over and over again. And what a great job. And we need more stimulus and this and that. And if they were just doing their job, they wouldn't have to speak. They say enough at every 6 weeks at the meeting. Powell has to speak in front of Congress every quarter, right?
Right.
And maybe Powell can give a few extra speeches, but there's no need for all this constant, for lack of a better word, cheerleading. Here's what we're doing. It's great, but we need to do more. It's great. Go. We need more fiscal.
But wait, you just said the right word, right? It is cheerleading. And because this is what the markets are hinged to is, the Fed said that they're going to do more, if they get more stimulus, they'll do more QE. Let's get in front of that and run these stock prices up. And this is what's called, in market speak, it's called jawboning, right? To where we're talking the markets up. And the Federal Reserve figured out that by jawboning the markets, they can actually get the effect of doing QE just by promising to do QE.
Right. That's right. I mean, they're doing everything in their power to keep and it's not just the stock market, right? They're just doing everything in their power to keep all asset markets where they're at. So just as importantly to them with the stock market are yields, right? Corporate bond yields hit junk bond yields hit all-time lows this week.
Right.
Mortgage rates hit all-time lows this week, right? I mean, they have a disaster on their hands if those yields go back up 1 or 2%, which in the past was a meaningless,
number. Yeah.
meaningless number. And everyone's looking at 10-year U.S. Treasury yields now around closing in on 1% and saying, oh, it could be a disaster if they go to 1.25%. And the Fed knows that. And that's why they have to constantly explain themselves and constantly go, rah, 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 look at us. Everything's great. The economy's doing well. We're really seeing some strong signs. And, it should be disturbing to everyone that they're speaking as much as they are, because there's really no need for it if they were doing what they should have been,
Let's be honest, first of all, and this is the interesting thing, back in the 90s, you remember this, is that if you ask somebody back in the 90s who the head of the Federal Reserve for, they couldn't tell, who the head of the Federal Reserve was, they couldn't tell you. I mean, Alan Greenspan was the guy behind the curtain. Once we got into 2000 and the Fed became so much more active, all of a sudden, everybody knew Alan Greenspan. Then they knew Ben Bernanke and they knew Janet Yellen. And now you ask people who the vice president is, most people can't tell you who the vice president of the country is or who the Speaker of the House is, but they can tell you the Federal Reserve Chairman is, right?
Right.
And this is, and that's not supposed to be the case. The Federal Reserve is supposed to be this invisible, behind the scenes entity that just makes sure that we're trying to manage inflation and maintain full employment. They have two mandates. That's it. Price stability, full employment. That's their whole thing. And they're supposed to be adjusting interest rate policy for that. And somehow, we morphed that. And this was particularly under Ben Bernanke in 2010. He specifically said, look, if I can inflate asset prices higher, that should lead to higher consumer confidence, and that'll flow down into stronger economic growth, trickle down, right? So this is the trickle down theory that has been a Republican, dream for like the last 40 years. Which doesn't work. All we did was bottle up all the wealth at the top of the ladder and nothing trickled down like it was supposed to.
Well, something trickled down, but it wasn't money.
It wasn't money. True. But here we are. We're still in that same point as, everybody knows who Jerome Powell is. And now the market's simply just, who cares about, earnings and economic growth and economic, quality. What's the Fed doing?
Right, because it's all. Our conversation today has completely come full loop. It's all about the markets, right? And what we've talked about today over and over again is that what's good for the markets isn't necessarily good for the economy. The economy is our wealth. That's our incomes. That's our future for our children. The market is the market. It is what it is. Right. And whether the market's really sold off a lot and is really cheap or is very expensive, that has implications. I'm not saying it doesn't, but that's not how we put food on our table. That's not how 98% of us feed ourselves or buy stuff or put our kids in college or our futures. And that's a problem. Again, we have our eyes on the wrong incentives.
Well, look, and we've even done this to the stock market itself, right? Apps like Robinhood and these other things, and those are great, right? We're giving more people access to the financial markets than ever before. That's awesome. But the problem is that, apps like Robinhood in particular don't teach people to invest for the long term. It teaches people to gamble. And they're great. They're going to, they're making, over the last couple of days was a good example, right? People were jumping into airline stocks because, we've got the vaccine, and that trade lasted 2 whole days. And if you're still in that trade, you're going to wind up losing money here because, the vaccine's not coming anytime soon. But we're teaching people to gamble, and the problem is that, and this has been all throughout history, this isn't new. Traders very rarely have a lifespan of more than about 2 years. They'll get into a hot streak just like a good poker player, and then the hand turns cold and they wind up losing the majority of their capital. And we see this over and over and over again. And, we talk about great investors of our time, right? Warren Buffett and just so many others, Ben Graham's, others who were great investors, but these were very long-term investors. They weren't traders. And the reality is that the majority of people that are investing wind up losing money because they don't invest properly. They gamble, rather than invest. They speculate rather than invest, and speculators have a very high propensity to lose money. But that's what we're teaching people. We're not teaching people to invest. We're just teaching them to speculate, and that's kind of long-term consequences as well.
Right. And it's from my non-market friends, in the neighborhood, or even my children. NIO, N-I-O, right? NIO. It's
electric car company, yeah.
China's Tesla, right? All I hear about it. I have yet to hear any one of them tell me anything about their income, their balance sheet, the company's plans.
Right.
Maybe it's a good company, right? But none of them know that. What they see is the stock price going up every day by these magical numbers.
Right.
Right? They don't understand the implications of owning a Chinese company and what the potential political ramifications are, both with the U.S. and within China. Can the company get enough market share? Even if they get market share, will there be competition in China and outside of China? Right. And look, it may be a great company. It may be the next GM and Ford. We don't know. It may be better than Tesla. But no one even considers that stuff. Well, and that's the problem.
Yeah, no, we were talking about this on the show, I think on Tuesday. There was this great chart out on the Wall Street Journal showing how many electric cars have now been sold over the last several years. And we've sold a total of 7 million electric cars. A lot, right? 7 million electric cars, kind of really putting some foot in the ground. Tesla's done a great job of innovating and bringing electric car, to reality. There's 3 billion people that drive in the world. They've sold 7 million cars. I mean, there's a lot of issues here in terms of profitability for these companies, and survivability is going to be an entirely different issue.
Right. And look, it's so easy to enter that business for these huge car companies, and we're seeing it now.
Yep.
Right. Volvo or Volkswagen, I think it's Volkswagen, has one out that is doing great in Europe. Right. And they're all going to have it. And look, electric cars will be the thing, but is it going to be NIO? Probably not.
All right, got to wrap it up for the day. Thanks for joining us. Get by our website. Get Mike's latest article on the website now, realinvestmentadvice.com. That's realinvestmentadvice.com. Have a great day. While you're there, send us your questions, comments, emails, whatever we can do to help you. We're more than happy to do it. realinvestmentadvice.com. Have a great day. We'll see you next time on the next Real Investment Show.
Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.